management, borrowing, how do you manage the borrowing cost, right? There are so many ways of understanding, right? First of all, negotiation. These are all things which are generic anyway. We're not going to talk about them. Negotiation of better terms, right? Try for a credit rating upgrade. If you have a high credit rating, all those things are fine. This is not our remit here. We are going to talk more in terms of how to look at, is there a possibility of refinancing your existing loans and what kind of currencies you want to go for and so on. Then we'll talk about interest rate swaps, how to manage the moving from floating to fixed and fixed to floating. Is there a way to manage your lower your cost? And finally, foreign currency loans. Right? This is I think where the bulk of opportunity lies. Right? So we'll talk about them in more detail. Sorry, Nigeria specific. No, I need to get back to you, please. I have not studied that. Give me some time. I'll come back. Thanks. Sorry. We'll come back to you. Okay. So let's continue with the discussion on this foreign currency, rather the interest rate loans, right? Okay. Now, before we do that, let's now understand clearly where do the markets price the interest rates to be in the future. This actually is a very important slide to understand two things. One, what is the expected market evaluation of interest rates as per the current market, which will determine your hedging cost if you were to hedge today. That's how market expectation is nothing but your hedging cost. Secondly, this table also will tell you what is the kind of tenor of hedging that you want to go with. Because while you do a swap or while you do something, hedge of an interest rate risk, you are paying certain cost. And that cost is determined by what is the expected evolution of interest rates in the future, right?